Topic focuses on net liquidity and the strategies financial institutions use to maintain adequate liquidity positions under both normal and stressed market conditions. Net liquidity refers to the difference between an institution's available liquid assets and its expected funding obligations over a given period. Maintaining positive net liquidity is essential because banks and financial institutions must meet withdrawal requests, loan commitments, operational expenses, and regulatory obligations continuously. Liquidity management strategies aim to ensure that institutions can satisfy these obligations without incurring excessive losses or disrupting operations. The topic emphasizes that liquidity management is not only about holding cash but also about balancing profitability, funding stability, and risk exposure effectively. A key component of net liquidity management involves forecasting cash inflows and outflows accurately. Financial institutions analyze customer deposit behavior, loan repayments, securities maturities, funding rollovers, and operational expenditures to estimate future liquidity needs. Institutions must also evaluate contingent liabilities such as unused credit facilities, derivative margin requirements, and collateral calls, which can create sudden liquidity demands during stress periods. The topic explains that liquidity forecasting requires both short-term operational planning and long-term strategic analysis because funding conditions may change rapidly. Effective forecasting supports decision-making regarding asset allocation, funding diversification, liquidity buffers, and contingency planning, reducing vulnerability to unexpected liquidity disruptions and market instability. The topic further discusses liquidity management strategies that institutions use to maintain resilience during periods of stress. Asset management strategies focus on maintaining sufficient holdings of high-quality liquid assets such as government securities and central bank reserves that can be converted into cash quickly. Liability management strategies emphasize diversified funding sources, including retail deposits, wholesale borrowing, and long-term debt issuance. Institutions also implement contingency funding plans that identify alternative funding arrangements during crises. The topic highlights that excessive reliance on short-term funding increases vulnerability to market disruptions, whereas diversified and stable funding structures improve institutional resilience. Successful liquidity management therefore requires coordination between treasury operations, risk management, and strategic planning functions. Topic also examines bank liquidity needs and the factors influencing liquidity demand within financial institutions. Banks require liquidity to meet customer withdrawals, loan disbursements, interbank settlements, and regulatory reserve requirements. Liquidity needs fluctuate continuously because banking operations involve uncertain cash flows and varying market conditions. Retail deposit withdrawals, corporate credit demands, seasonal business cycles, and financial market volatility all affect liquidity requirements. The topic explains that banks must maintain sufficient liquidity not only to meet expected obligations but also to preserve customer confidence and market credibility. A bank perceived as illiquid may experience funding withdrawals and declining market access, potentially escalating into broader solvency concerns. An important concept in bank liquidity management is the distinction between expected and unexpected liquidity needs. Expected liquidity needs arise from predictable operational activities such as scheduled payments, maturing liabilities, and normal customer transactions. Unexpected liquidity needs emerge from sudden deposit withdrawals, market disruptions, credit downgrades, or economic crises that significantly increase funding pressures. The topic emphasizes that banks must prepare for both situations through stress testing and contingency planning. Stress testing frameworks evaluate how liquidity positions would respond under severe but plausible scenarios, including economic recessions, funding market freezes, and systemic financial shocks. These analyses help institutions identify vulnerabilities and establish appropriate liquidity buffers. The topic also discusses the role of asset liability management in addressing bank liquidity needs. Banks must balance the maturity and liquidity characteristics of assets and liabilities carefully to avoid excessive funding mismatches. Funding long-term loans with short-term deposits can increase profitability but creates refinancing risk if deposits decline or funding markets tighten. Asset liability committees monitor liquidity ratios, funding concentrations, and maturity gaps to ensure the institution maintains sustainable liquidity positions. The topic highlights that liquidity management involves trade-offs because highly liquid assets typically generate lower returns than less liquid investments. Effective management therefore seeks an optimal balance between liquidity safety, profitability, and risk tolerance. Topic also focuses on legal reserves, which are mandatory reserve balances banks must maintain with central banks or regulatory authorities. Legal reserves serve as a safeguard to support financial system stability and ensure banks maintain minimum liquidity levels. Reserve requirements are typically calculated as a percentage of customer deposits or specified liabilities. By requiring institutions to hold reserves, regulators reduce the risk of excessive lending expansion and improve the banking system's capacity to absorb liquidity shocks. The topic explains that reserve requirements also influence monetary policy because central banks can adjust reserve ratios to affect lending activity, money supply growth, and overall economic conditions within the financial system. The final section emphasizes the broader role of legal reserves and liquidity regulation in promoting banking system resilience and financial stability. Reserve balances provide immediate liquidity support for settlement obligations and customer withdrawals during periods of stress. In addition to reserve requirements, modern regulatory frameworks such as Basel III introduced liquidity coverage ratios and net stable funding ratios to strengthen institutional liquidity management further. These regulations encourage banks to maintain high-quality liquid assets and stable funding profiles capable of withstanding severe market disruptions.